Well, soft economic landings has been bandied about a lot over the past 12 months or so, particularly in the United States. We know the Federal Reserve has been embarked on an incredibly aggressive monetary policy tightening schedule. So is there such a thing as a soft economic landing? Let's go and get a view from David Clark from Cameron Harrison, who is standing by via Skype. David, great to have you back on the program. I wrote about soft economic landings in my view earlier on this week. I've never seen a Fed in particular be able to go and deliver one, particularly when it's been very high inflationary pressures. Will this time be any different?
No, I've got to say I tend to agree with you. Given the amount of commentary that we've been seeing on soft economic landings, we went back and had a look at the 4 times in history that the US Fed's managed to engineer one, if you like. And in each one of those cases, it's not so much what the Fed does, but just a combination of macroeconomic conditions that make it more favourable. So, the one true soft landing that everyone points to back in 1995 was as much to do with the Fed as it really was to do with globalisation. If you look at history, any time the Fed has needed to slow down the wage market, so the labour market, and increase unemployment, say, by 0.5% or more, it's almost always ended in a hard landing. So it is somewhat surprising that when you look at markets at the moment, almost everywhere you see, they're pricing in a very, very mild recession at best.
What are your expectations about what the Fed tightening that's already taken place will actually go and mean when it comes to economic activity? You mentioned that 0.5 percentage point increase in the unemployment rate. What do you expect we'll see in this particular cycle?
Yeah, I think we need to see a lot more than 0.5% to slow down wage growth at the moment. So we'd be looking to see, at a minimum 1.5% increase in unemployment. The labour market in the US is incredibly strong. Effectively, post-pandemic, they had a lot of older workers leave the workforce and they haven't come back. The economies continue to roll on very strongly with fiscal support. So effectively, you have too much economic activity for too few workers. So to correct that, the Fed's going to have to keep raising right the way through the first half of this year, and really won't see wage pressures come down to an acceptable level, say 3.5% per annum in terms of increases, until unemployment is significantly higher.
We've seen a big decline in the credit impulse in the United States and other parts of the world as well. You're looking for quite a sizable increase in the unemployment rate as well. Combined, that doesn't point to a very strong demand backdrop, which then begs the question, US earnings. Of course, we're going to get that in focus later on this week when the big banks start to go and kick off the fourth quarter reporting season. Do you think that the risk to earnings have been adequately priced into these markets right now?
Yeah, not at all. If you look at where consensus forecasts are, they're only 5% below the highs in 2022. Even in a very vanilla recession, you'd expect a decline in EPS of 20 to 30%. And really, over time, if you look at that decline, it's become increasingly magnified. So with each ongoing recession, that EPS decline has been higher and higher as corporate leverage has been higher. So, right now, you're almost seeing markets priced for no recession, and at best, a recession that doesn't even touch the sides.
Where do you think the biggest risks are for earnings when it can narrow it down to sector level? What are some of the areas that you're particularly concerned about that don't really look like they're priced in that threat yet?
Yeah, that's a good question. I think we've seen sectors that have started to price in, earnings decreases. So some of the industrial area and consumer discretionary, they've priced in earnings decreases, and we're actually starting to see some sort of reasonable valuations there that we've been looking to add to our portfolio. So really, it's as we go into an environment where earnings growth is a bit harder to get, you either want to be in defensives or areas like industrials that have already priced it. So the rest of the market looks a bit shaky from our view.
When you talk about defensives, what are some of the areas you could go and point us to? We know that healthcare is one that typically does fairly well, given a lot of the structural shifts that are underway when it comes to demand. Is there any other areas you could go and point us to?
Yeah, I think staples look attractive at the moment. So, classic example would be, supermarkets and the like. As we're in a cost of living crisis, as often gets thrown around, people are going to start spending in different spots. They're going to continue to need to spend to eat and live. So those, staple type investments should be able to continue to generate revenue and earnings.
In the rates universe, we're seeing a big bull, no steepening of sorts when it comes to what's been going on in the market. But particularly at the moment, we're seeing that there's still a lot of rate hikes priced in at the front end of the US curve in particular. When you look at how the rates universe stacks up at this point in time, as an investment destination in these uncertain times, does it still stack up even though we're seeing that decline in yields?
In interest bearing, sure. I think in the US, that forward yield curve, looks pretty accurate. You're going to have to see at least what's priced in or a bit more. What's interesting is the longer end of that curve doesn't seem to be pricing in much of a fall in interest rates. So you'd expect that should we have a recession, you'd get a pretty sharp fall in the Fed funds rate, and that's not priced in at all. So there are some opportunities, that will come up throughout the middle of the year, particularly in adding in a bit more duration to the portfolio for bond investors.
David, just to go and round off, emerging markets certainly have been the topic du jour, and a lot of excitement, particularly around China's reopening, seen in the past month or so. When you look at the EM universe, we know it's been hit really hard by rising interest rates, by a very strong US dollar. Is it an area that you're looking at this point in time, or is it still an area that you're trying to avoid?
Yeah, we're still looking at it. I think China's reopening will be pretty interesting. We expect it to follow a pretty similar pathway to other Southeast Asian countries, so notably Taiwan was a good example where, and we went through this in Australia back in 2021, 22, where you start to reopen, so the spread of the virus is higher, and you get a high increase of workers taking sick leave, and so you get this yo-yoing effect of opening and closing, opening and closing. Certainly, the shift in position of China to a reopening will be supportive broadly for emerging markets. We prefer to take our positions for emerging market exposure through companies that are listed in developed market markets, so that we can have that reliability of earnings and governance.